Are you ready to win in the coming recession? While everyone panics, the savvy rich are playing a strategic game. Unlock the cheat codes with our game-changing strategies. Buckle up for 2024. Inflation's soaring, interest rates bite, and a recession looms. But don't fear. Unearth the opportunities hidden within. This video delivers proven and effective recession-proof strategies to not just survive, but thrive and get rich. As concerns about a potential economic downturn in 2024 loom, it's a smart move to consider investing now. While layoffs and unemployment dominate recession discussions, there's more beneath the surface: salary cuts and declining asset values. This downturn won't be quiet. It'll ripple through global markets, impacting corporate earnings and consumer confidence. Challenges include synchronized extreme weather events, predicting disruptions in food production, supply chains, escalating costs, geopolitical tensions, and widespread migration. Clever investors recognize these interconnected global events, strategically positioning themselves for opportunities amid the chaos. Let's delve into the current state of the stock market and explore its potential impact on your financial standing. Personally, I find it intriguing when stocks experience a downturn. It's a scenario I've been navigating since I was just 11 years old. To me, it's akin to a sale on investments. A drop in prices spells good news, much like when the cost of hamburgers or Coca-Cola decreases. According to the Atlanta Fed's jobs calculator, the US is anticipated to shed a staggering 97,000 jobs per month, marking a significant development bound to stir the waters of investments. Examining the present stock market landscape reveals that major players in key indexes have seen a decline ranging from 10% to 20%. Insights from JP Morgan hint at the possibility of further declines in the foreseeable future. However, this isn't necessarily breaking the mold. Historical data since 1946 shows that during tough times or bear markets, the average drop is around 30%. The most severe hit occurred in 2009 when the S&P 500 plummeted by a substantial 57%. Introduce a recession into the mix, and things get even more uncertain, with an average market drop of approximately 34.8%. Interestingly, this tends to happen when panic sets in and investors rush to sell off their stocks. Here's the twist in the narrative. Each time the market experiences a crash, it has historically bounced back with increased resilience. The S&P 500 over time exhibits a fascinating pattern. After each crash, it not only recovers but comes back even stronger. What does this mean for you? Despite the challenging times, there are strategic moves you can make to fortify your wealth. In the coming months, we anticipate witnessing noteworthy developments in the market that could serve as your ticket to making astute investment choices. It's a crucial time to pay attention because these shifts could position you for substantial long-term gains. Let's stay focused, keep our eyes on the ball, and make shrewd plays to navigate this economic shakeup successfully. Having explored the anticipated economic landscape for the upcoming year, it's evident that substantial changes, particularly in the real estate sector, are on the horizon. Over the past 6 decades, instances of significant downturns in home prices exceeding 15% have been rare. However, Wall Street experts are currently foreseeing a potential nationwide decline in housing prices, ranging from 5% to 10% in a more conservative estimate. In a less optimistic scenario, where interest rates continue to rise, this drop could escalate to a range of 10% to 25%. It's crucial to note that the real estate market is intricately tied to location, with certain markets being more susceptible than others. If a decline occurs in one of these vulnerable areas, it might persist for a few years before stabilizing. Homeowners, especially those with fixed-rate mortgages planning to remain in their homes for the next 5 to 10 years, may find these fluctuations manageable. However, for individuals eyeing property investment or contemplating new purchases, this could be an opportune time. As we gaze into the future, the real estate market presents a landscape of both challenges and opportunities. Home buyers and investors poised to navigate these changes may encounter attractive deals amidst this economic shift. It's a dynamic scenario where strategic decisions could lead to advantageous investment opportunities in the midst of this evolving economic landscape. In times of economic turbulence, maintaining a cash reserve isn't just a prudent move, it's a necessity. While the conventional wisdom often advocates for investing your money, there's a certain comfort in having a financial safety net readily available. Cash, often criticized for its vulnerability to inflation, becomes a secure haven when the stock market and other assets experience a downturn. Picture it as a financial security blanket, providing a safe parking spot for your funds, especially during unexpected events like a job loss. Consider the concept of an emergency fund covering your essential expenses for several months: rent, food, bills, and the like. Interestingly, during the challenging financial landscape of 2018, those with funds in high-yield savings accounts outperformed those navigating the stock market's uncertainties. Even prominent investment managers are increasing their cash holdings, recognizing its value as a safety net in shaky economic times. And then there's gold, a historical haven that tends to shine brighter when stocks decline. Instances like the 1970s and the 2008 financial crisis have demonstrated gold's reliability as a steadfast friend during market turmoil. Joseph Sherman from the Gold Alliance notes that when stocks and bonds falter, people often turn to gold as a vote against economic uncertainty and a hedge against governmental or banking instability. However, it's crucial to remember that stashing cash or investing in gold may provide short-term security, but isn't the ultimate solution for long-term growth. Warren Buffett's perspective emphasizes the importance of considering other productive investments for sustained profits. It's all about finding a balance, keeping some cash, perhaps a bit of gold, while also planning for the long game. Diversification and risk spreading are the keys to being well prepared for whatever economic challenges come your way. Diversification, often dismissed by seasoned investors, serves as protection against ignorance. By spreading your investments across various assets, international stocks, real estate, and more, you mitigate risks associated with market volatility. If one sector experiences a downturn, the diversified portfolio shields you from substantial losses. Consider leveraging the current economic climate to enhance your financial standing. Whether through extra efforts at work, pursuing a side hustle, or freelancing, additional income can fuel your investments. For instance, if you're a graphic designer, explore freelancing opportunities, or turn your passion for baking into a small business. While riding out a recession is challenging, the upcoming one in 2024 presents opportunities for wealth growth. Maintain a regular investment routine, even during apparent stagnation. Diversify your portfolio to safeguard against significant losses, and put in the extra work to boost your overall growth. Remember, navigating a recession is akin to steering a ship through a storm. Stay calm, adhere to your course, and leverage the turbulent times to your advantage. Dive into the heart of the recession. Be proactive in seeking undervalued assets and adapt to the changing landscape. Share your plans for seizing the 2024 recession's opportunities in the comments below.